Hey everyone, hope they're having a good day. My name's Andy. My channel is Finding Value. Uh, Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in and take a look, see what people are sharing, and I'll interject my financial opinions. If you want to follow me at Finance, and if you want to join our community, finding-value.com. I do a lot of the heavy lifting and looking at sectors, looking at the ratios, technical analysis, all of those things combined, looking for investment opportunities in individual companies. I am looking for stuff that has huge asymmetry, big upside potential, buying it at what I think are pretty good places. I mean, obviously, no one's going to be perfect, but good risk reward areas, looking for big asymmetry, big upside potential, small downside risk is what asymmetry is. And then sharing that with everybody. I also go through a lot of trainings, a lot of question and answer sessions where people want to learn things and ask me questions, and I'll share whatever I know about the topic. We do have a coupon code special. Is that coupon code if you're interested in joining? And we've got the special in the description link below. So, Unusual Whales says Americans believe an average net worth of 2.5 million is necessary to be considered rich. A 14% increase over 2023 per Charles Schwab. Do you agree? I think it all depends. I mean, it depends where that money's located. If you own $1 million house and you've got 1.5 million in liquid, that's pretty good. Um, if you've got 2 million liquid and you have a $500,000 house, that's even better. Your net worth isn't a factor of if you can, if you, how can I say this? It's not about being rich. It's about being wealthy. Wealthy, you can walk around and do whatever you want when you want. You control your time. So if you're in California and you have a net worth of 2.5 million and it's all tied up in your house, you are not wealthy. You're not rich. If you're in Kansas and your net worth is 2.5 million and you have a 250 or $500,000 house and it's all liquid and it's spitting off, let's say you're getting 15% dividend yields on 2 million, then you're making $300,000 a year in dividend yield. Yeah, you're doing quite well and you are pretty wealthy and rich. So it has nothing to do with a net worth and being rich. It's the ability to do whatever you want when you want. That is what I consider someone to be wealthy, is to have control over your time. So it doesn't matter what the average American or what Americans believe the average net worth of being rich is, because it depends on where you're located. And it depends on what your wealth is generating in income. It doesn't matter if you've got a bunch of net worth and it's all tied up into things that don't generate income. GDXJ divided by gold. So gold, year of the gold junior miners for 25 and 26 for your information from Hinster. What I see here is gold, which is the gold line. It's ripping higher. And then what we see on the bottom here is GDXJ divided by gold, which is way down here in no man's land. Why do we have that? Why is there such a disconnect between the junior miners and the gold price? We've seen this disconnect before. We had a massive move in the 1970s. It also had a massive move, the junior miners, in the 1990s. We had a big run up too. And I think we're going to have another big run up here at some point. Now, a lot of people are going to say it's a dead opportunity, hasn't broken out yet, all that garbage. Well, you have to watch it. The opportunity may not be immediate. Maybe it does. Maybe some of the companies are breaking out, and maybe the average GDXJ ETF hasn't broken out yet. You have to look at all that stuff to see where the opportunities are. And then you follow it, you watch it, and then you buy it when you feel like buying it. Some people are okay with waiting a while. I am. Other people say they only want to buy when things break out, but your return could be, 5x less waiting for a breakout. So is the patience necessary? It is if you get that much greater of a return. It all depends on where you purchase things. Your best risk reward of anything, not hypothetically, if you were to take all charting away, all right, and you just said, where's your best risk reward? It's the areas where where the stock is way down, where the best value is. It's not about a trend line breakout necessarily. Now, from a technical person, they might say, well, the least risk way for someone who doesn't know anything about the sector or the companies, well, yeah, it's less risk for them when it breaks an artificial trend line that we put in. That makes sense too. So Northstar says, do you know the tech stock index Nasdaq is up 445% from its peak 25 years ago, but it's down over 50% compared to gold? Has the penny dropped yet? It's all a fiat illusion. Do you have, got gold? Well, you're charting the market conditions. The market conditions since 2000 have been in a Kondratiev wave, which is good for commodities and precious metals. And everyone doesn't even know that. The majority of people have no idea that gold has outperformed the NASDAQ since 2000. And since 2000, we're in this big bull market for commodities. We had a major pullback from 2011, 2008-9, all the way to 2020. 2020, we rolled over, and then we've been rolling over in a topping process ever since. That's this whole area over here. This is a one big topping process where gold's going to break out against the NASDAQ where this goes downward in that ratio. And people are going to tell you, well, I can't wait. It's a lost opportunity. They're going to go diving into crypto at the top of the market. Crypto and all of those, like the meme coins, that is the extension of the top of the market, in my opinion. Foolishness, extra liquidity in the market is going to go into stupid crap and blow up bubbles. And then eventually what happens is the things that actually matter in life, the real crap that you need to survive, will go way up in price because we have underinvested in all of the real stuff. And money is going to float away from the crap that's not needed to the crap that's needed. It's that simple. So you flow from these big bubbles like the 90s going into 2000, big bubbles like that. All the money flows into the crap that you don't need. Declining interest rates, hard assets they're plentiful. We overproduced in the 80s and early 90s. We go in where things tighten up. 99, 98, 99, 2000. Money starts coming into the system, and then money rotates into things that we need, not the things that we want. That's what 2000 on to 2011 is. That's a big commodity bull market. And this just shifts back and forth, like a sine or cosine wave, whichever one floats your boat, depending on where you started, right? We came in and liquidity came into the system. We had a whole bunch of oil that was drilled for shale oil. All that stuff came on, and money flew into financial assets and crap that we don't need. And now it's going to flow all the way back into the crap that we need. It's going to be a hard asset, precious metals bull market that I think could be one of the biggest. And really, what kicks this thing off is credit creation and the supply of commodities being constrained. So projects not coming online fast enough, oil not being produced at fast enough quantities for consumption to keep up with credit creation. I asked ChatGPT to plot me 3 scenarios of where the uranium spot price is estimated to be over the next 60 months, based on analysis of the current deficit versus demand and on historical price action. The results are amazing. See the scenarios that follow. Well, the base case, 4 to 6x increase going to $350-ish. The historical case is a 6x, where we go to about $400. And then the bull case is 5 to 8x, which goes all the way up above $500 a pound. Do you know what else I think is going to go that high? Oil. Oil prices are going to go that high. And I think uranium and oil prices are going to be very similar in the cost per pound or per barrel. They're going to be similar. That is your bull market. Now, that's what ChatGPT says. Is it going to be right? I don't know. My calculations, you can get ridiculous calculations depending on how bad this thing squeezes up. Did you know that uranium was the same price of oil in the 1970s? And in the 1970s, we had plentiful inventory levels. We didn't even squeeze inventory levels back in the last bull market in the 2000s. Well, what if we actually squeeze the inventory levels? That is where I think this could be even low, potentially. It all depends on if people panic and what the inventory levels. If inventory levels are low and people panic, I don't think we're going to be clearing, we're going to clear 300 like it's a breeze. Same with oil. If we peak, if we have problems producing oil in the world, people start to panic. You're going to have wars. Prices are going to go vertical. I mean, it's the way it's going to be. We've already peaked in conventional oil in America for sure. That's been declining. We've peaked in the world conventional oil, probably 2018. And now we're going to test the entire world's production in its entirety, conventional and unconventional. And we'll see what happens. Manish Pabri's latest portfolio is very interesting. He's got Tav Airport, Idelvas, Financial Services in India, Alpha Metallurgical, Warrior Met Coal. He's got some met coal for steel, Occidental Petroleum, Toll Brothers, Pulte Group, Asbury Automotive, Group 1 Automotive, and Auto Nation. You know what I see? I see a person who understands the real estate market. It's the real estate cycle that's driving this. Toll Brothers, Pulte Group, and these up here, yeah, it's a real estate market. You're not going to invest in steel if you don't think a real estate cycle's coming. Fred Harrison, what the politicians don't want you to know is the 18-year real estate cycle. And this is what drives interest rates. It drives the stock market during certain periods of this. The stock market, like tech and S&P, do real well over here. They don't do as well over here. And they don't do as well over here in some of these areas is because interest rates go up. It causes a midterm peak, a mid-cycle wobble. Now, here's the thing that I don't, this is where my question is. Is the midterm peak 2020, 2022, are those correct? Or is the mid-cycle wobble ending somewhere later? And is the winter curse really going to be 2025, 2026 cycle peak? I don't know. I think we could go a little bit longer than that. How do I know that? Usually in the mid-cycle wobble, you have interest rates go up, and then they lower interest rates. Something to do with interest rates. 1980 was a mid-cycle wobble. Out of that, and 89 was the peak. Or, sorry, it'd be, 89. 1990 was the rollover cycle peak. But here's 2027 with 2030 being the deep recession. I'm not sure if that is it. We're going to have to wait and see. There are markers of what I look for to see if this thing's rolling over. And I don't need to know the exact timing. We can get a rough location. And this is the real estate cycle. To add 2 years to this, if 2026 is the cycle peak, that means that commodities will peak like 2028, somewhere in that range. Stacking data on top of each other. Oil charts, ratios, gold breaking out against equities. It all adds up to tell us where opportunities are at. And we can use fundamental and technical analysis to take advantage of what is coming. So this is your ideal buy for your investor. It's a double bottom, and then A and B. B is where their ideal buy is for an investor, typically. The breakout is A, and the backtest is B. I try buying the bottom down here because the returns are so ridiculous. Sometimes when you go from here to here, it's like a 10x. So I try buying stuff that's real low. But this is Canadian crude. It's the double bottom. The breakout is A, and the backtest is B all through here. That's what we have for the ideal entry point. I did buy in 2020 down here. And when I came up all the way here, even where we're at located, I'm up well over 10x on a handful of companies that I purchased in 2020 at that bottom there. And I purchased it specifically in Canadian crude, in crude oil, the companies that sell Canadian crude and sell crude oil, because I thought we were going to be bottoming for the bottom of the commodity to stock ratio. So I knew all this back in 2020. I created my channel in 2020, August, and I started posting some of the companies that I purchased shortly thereafter. And this is what it looks like. And we're gonna break out of this, and it's gonna be a huge run. And people are gonna be, they don't know the big picture. They don't know the cycle. They don't know the big picture. They don't know ratios. They don't know what's cheap. They don't know what is expensive. All they do is they just run around chasing price performance. That's all they do. The gold to oil ratio, 30x is like super cheap. So gold expensive to relative to oil. Oil, when it went all the way up in 2020, look what it did. That's an anomaly. The COVID-19 pandemic, a slowdown in economic activity, and the debt-driven stimulus packages by government are all factors in the recent gold rally, and with oil rallying off the bottom of 90. It was an anomaly in history. If you just dumped a whole bunch of money in oil during this anomaly, you made a killing. And here's our ratio right now. It's 40 to 1. 40 to 1. 40 puts you up here. That was in the early 1800s. There was one time in, looks like the 1930s, probably the Great Depression. And then no other time in history outside of the COVID where they stopped the economy and they didn't know what to do with oil. Because it was literally, they had nowhere to put it. But that's it. You've got 1, 2, 3 times in history going back to the 1860 where you could buy oil at a 40 to 1 ratio. Or the equities. This is such a great opportunity. Such a great time to be alive. Here's commodity to stock ratio for the chart posted below. So what do we have here? 1930. So we've got 1970 here. That's a low that started coming on up. And then we've got over here, this is 2017, but it bottomed somewhere in that range. 2020 it bottomed. Now some people are going to say, oh, this is dead money here. It's dead money. Well, don't put it in the 1950s. Wait for it to bottom and wait for it to come on up and get invested. 1971 is when they let gold float. And that's when things all took off. So gold is already taking off. What do you think commodities are going to do? It's going to follow gold. This was a revaluation of gold. Back here, revaluation. They let gold trade freely. This one came all the way down. This was the 2000 bull market for commodities. And we're down there again. Coming down to the next one, we've got, remember this one, overlay it on your ratio charts of big turning points for commodity to stock ratios. Sizing up the big trend is where the big money is made. And obviously holding in patience is also where the big money is made. And if you look at the U.S. stocks versus bond returns from 1926 to 2022, in this lower left corner, 1931, 1969, and 2022. What does this mean? It means that the U.S. bond market return and the U.S. stock market return both were negative, and they were negative pretty bigly. The U.S. stock returns were down 20%. This is probably 5 or 6 or 7%, something like that. And then bonds were also down. What does that mean? It means that interest rates were going up, bonds were selling off, and stocks. 31, 69, 22. 31, 69. And 2022 was just recently with a low commodity to stock ratio. So I hear a lot of people say, well, when is this going to occur? I think we're right at the beginning of it. We're right at the beginning doorstep. And within any second, I think we're going to take off and have a big commodity surge where this comes back up again, just like in 31, just like in 69, and just like in 2022. And we're going through this topping pattern in the Nasdaq, S&P, and I think we're going through the bottoming kind of phases in commodities, just like I set up here with this bottoming phase in Canadian crude. This is a bottoming pattern. This is a bottoming pattern. And then we've got this cheap ratio for oil against gold. And gold's starting to break out against all the other assets, the financial assets like the S&P 500, the Nasdaq, all of those things. That's why I've been going through all of these Twitter posts showing you the big rollover of all of those. That's the beginning. It's all interconnected in this market here of money rotation. Here's the volatility index. And usually when things drop, we get a spike in volatility. And you can see a spike here in 2007, 8, another spike here for 2020 COVID. And we've had a spike here. This was the yen carry trade, and we're still above that area. Sometimes you can get like a double spike here. So that is still possible. And there's the zoomed in on the right-hand side, the spike here, and then the relaxation of it. Bull market in progress for uranium. Patience is all that is required. I know people are like, well, how come it's not going? It's just going to go all the way up. Been waiting for the bull market since 2021, it says in the corner there. Guys, we're in the bull market. It started when this downtrend broke in 2020. That's exactly where I purchased it, was right on this break over here. I bought a whole bunch, and I've just been sitting in it the whole time. Yeah, I bought some more over here too. But again, even if this drops down and we're to drop down and then go back up, it doesn't matter. Longer term, we're in the bull market. Patience, patience, patience. Now, here's another thing I've noticed. Uranium is really long. It takes a long time for uranium to kind of go through its bull market. It's not short cycle, it's real long cycle. It takes longer. The short cycle stuff that I've noticed has all been crypto. It seems to cycle through from bottom to top very rapidly. So that's some things that I've seen in the markets there. Copper looks good to launch, perhaps. So copper, we've got this big consolidation launch in the mid-2000s. We consolidated again with a nice three-hump consolidation, 1, 2, 3, angling upwards. We broke out of that in 2020, and we've consolidated sideways here, ready to rip again. The bull market started in 2020 and 2021 when we broke through here. That was the beginning of the bull market. This is a consolidation of a big flag pattern. It is so important to understand where you're at in the cycle. I see a lot of people, what happened to the bull market? Where's the super cycle? We're in the super cycle. It's going to keep stepping higher and higher and higher. And it's hard for people, I think, to wrap their head around that because it's not going up tomorrow or a month from now or a week from now. Like they think that these consolidations means the bull market is over. I think they're very confused. If you look at this hump here, hump 1, hump 2, hump 3. Hump 1, hump 2, hump 3, and then we are going to go. And it's angled upward. So it's these three-hump consolidations angled upward, three-hump consolidation angled upward. And we're going to break through here on copper. It's all part of the big bull market, big super cycle, yeah. Where's the demand from silver coming from? Here's electrical, electronics, photovoltaics, other industrial, brazing, alloys, and soldering. Investment, jewelry, silverware, and photography. There's the whole demand. Electrical and electronics, that's got it's a big chunk. Photovoltaics, look how big this was. Pretty small back in 2015. Look how big it is over here. That's a big chunk, baby. Other industrial looks pretty big too. Moving all U.S. spending to the blockchain would reduce fraud in the U.S. Treasury budget from 24% to 0% overnight. Even if just 1% of U.S. spending goes to waste each year, that's $69 billion per year. Well, I don't think we need to go to a blockchain. Why don't you just have gold and silver and block all the people from money printing through gold and silver? Then they would have to forcefully steal it somehow or break the link to the gold and silver backing. And what they did is they created it to just the fiat currency in 71, and now they're just stealing from the currency. You have to have some sort of block or linkage to something that you can't exponentially inflate. I'm not a big, you could do blockchain. It doesn't matter to me if we do blockchain or not. I just don't want to be forced into a central bank digital currency system where everything gets tracked for me. I don't want all my transactions out there where they know exactly what I'm doing, what I'm buying, and all that stuff. I'd rather have them just go to Visa and MasterCard and figure it out. But I get afraid because they can shut this down if they own the blockchain. They can shut things down. They can do things that I don't want to be stopped. The long investor. So long-term investing is always the way. Out of 74 years, there's only been 16 negative years. The S&P 500 returns from 50 to 2024. So what I always do is I go, okay, where would I be invested? I would have been in commodities from 69 probably onward. 68, 69 is where I would have started to accumulate. 70, 71, 72, 73, 74, 5, 6, 7, 8, 9, and 1980. I would have been in commodities. I might have sold, maybe not. I would have purchased stocks in 82, knowing what I knew. And then I would have gotten all these returns here, which is just ridiculous. It would have been one heck of a ride. In 98, 99, I would have swapped out in somewhere in this time frame here, probably 99, into commodities. And then you can see the returns here. 2000, 2001, 2002. That's when the commodity to stock ratio went ballistic. So in 82, you were up here where stocks were cheap to commodities. I would have bought them all up here. Even if I bought it in 1981 over here, I still would have waited a couple of years, and then I would have rode it all the way down. And then in 99, 98, somewhere in this range here, I'd buy a bunch of commodities, come up. I don't know if I would have sold here. I would have bought tech stocks in 2011, perhaps, on the technicals. Rode it all the way back down. And then in 2020 is when I swapped my tech stocks into commodities. And I bought the bottom, not the bottom, but I bought around the bottom. Like September, October, I bought a whole bunch of oil and uranium and energy service related stocks. So I'm using this ratio as where to invest. Yeah, I bought it right. I bought it right here when I started my channel, YouTube channel here. Housing market is still broken. This guy says here's asking price per square foot, which just smashed through another record high. Note that homes aren't more expensive because they're newer or larger. The median pending square foot is under 1,700, but because the Fed ruined the market with interest rate manipulations. I don't think that's the case. I think that it's all just supply demand, and people are bidding stuff up because there's a shortage of homes. It has to be that. Now, you can argue that supply demand with lower interest rates gives it more fuel, correct? And there's more money in the system, which then bids prices up even further. But it's supply and demand. It has to be that. There's no other way. Go look at China. They're printing a whole bunch of stimulus. And guess what's happening to their home prices? They're going down. Why? It's supply and demand. There's no demand. It's the demographic. Peter Schiff says, the U.S. Constitution does not authorize the federal government to loan or grant money to anyone. U.S. aid is unconstitutional. How can it possibly be a violation of the principles of our republic for Trump to dismantle an unconstitutional agency that never should have been created? Dude, they just started that and funnel money through it. It's absolutely ridiculous. Give me a thumb up for the content, subscribe to the channel, subscribe to the website. That's all I've got for today, guys. And if you want to sign up to the website, use the coupon code SPECIAL for savings. And we'll see you next time. This is Finding Value.